Hello everyone, hope everyone is doing well. Today I want to share with you a financial statements, bookkeeping and financial statements template for service-based small businesses. Okay, so ladies and gentlemen, with that said, let's get straight to it. So the way the template works is by filling in these tabs below. Okay, you'll fill in steps 1 through 5 for the most part. And then you'll also fill out the two ancillary tabs here, depreciation and interest worksheet. Okay, so let's start up at step 1. I'm not gonna go through these line by line. Just give you a glimpse of what that tab is. You'll fill that out. Okay, so just a quick overview. We're here in September 2025. If you wanted to start sometime today, you'll grab your bank statements and fill in the beginning balance. So January 1st, that's pretty self-explanatory. Fair market value, because you may have had the vehicle in use 2-3 years already in business, so 2-3 years of depreciation is already on that vehicle, so you don't want to enter in the original cost of the vehicle. Okay, in that case, you want to enter in the fair market value as of January 1st, and then depreciate 5 years going forward. Okay, or if you already had your books prepared before, you know what it is to have yearly financial statements, but you now want to use this template going forward, then you would use the book balance. You would pick up the book balance from the balance sheet and enter that amount here. Okay. All right. Step 2. This is after initial setup, so going through pretty much the same as step 1. These two tabs, step 1 and step 2, pertains to the balance sheet accounts and the balance sheets, that financial report. Okay. Step 3, this is where the fun starts. Looks a little bit busy. All right, looks a little bit complicated. It's really not. It's pretty straightforward and simple. Trying to keep this streamlined. The key here is that you're using your business bank account, especially for this tab, step 3. All right, in particular for step 3. All right, so enter in business income received, enter in loan repayments due to the business owner. So this is money paid from the business bank account back to the business owner. Okay. Same for other loans repayment, money paid from the business bank account to the financing company. Okay. And then enter in money you withdrew from your business for personal reasons. So you may stop at the ATM, swipe the business debit card, and withdraw funds. You'll enter in those amounts here. And then there's a laundry list of expense accounts here that may pertain. Hopefully it's a catch-all list. All right, and you could find the applicable expenses to your unique small business here in this list. You'll fill that out to what those expenses are per month. Okay. If you can't find an expense that pertains to your business, then here's a miscellaneous expense account. You can enter the amount there. Okay. The far right column, this is a calculated field. It will total up the rows for each of the sections. Okay. All right. So step 4 is pretty much the same thing, but this is pertaining to the credit card account. So expenses paid, business expenses paid from the credit card, your business credit card, and then also you may have used your business credit card for personal use. And this is what this section is about. Again, pretty self-explanatory and easy, straightforward. Let's keep it rolling. Step 5. And this is pertaining to business expenses paid from your personal funds. Sometimes you may be out running personal errands, but at the same time you stop and you pay for some business expenses along the way using your personal funds or your personal card. So here it is. If that's the case, you pick up those expenses here. So the key is to have records, right? The key is to have concrete records, right? And these things are recorded and kept and filed in a systematic and rational manner, okay? And there's no denying what these are, even though they were paid from your personal account. All right, that's the key. All right, again, the far right column is calculated fields. In that column, it totals up each row of expense. Okay, all right. So again, based on what you entered so far, these financial statements, the balance sheet, and the profit and loss statement, which is actually a combo statement. So you get a bonus financial statement here. You get a statement of changes in owner's equity, also along with the profit and loss statement, okay? Again, auto-generated based on what you entered in. So in this example, you can see the beginning of year balances for the balance sheet. They're all in balance. And so it's the same. It's the same for the end of year amounts, okay? You know, assets equal liabilities plus equity. So assets 14,000. Total liabilities plus owner's equity equal 14,000. Okay. Get into the ancillary tabs. Depreciation. Again, it's not a perfect math. It's not meant to be perfect. This is for real small businesses, service-based small businesses. Okay. And clearly states this is oversimplified depreciation calculations. No mid-month, half-year conventions or any partial year conventions here taken into account, but it will do. Okay. We have in this example, this particular example, you have two different categories of fixed assets: 5-year depreciation and 7-year depreciation. Okay. Vehicle, computer equipment falls under 5-year. Fixtures and furniture fall under 7-year depreciation. Okay. The cost, total cost, this comes from the balance sheet. Okay. Here it is. Vehicle is 10. Computer and equipment is 2. All right, so those two are the 5-year. That's 12,000. Here it is, 12,000. So everything here in this section, in this tab here, depreciation expenses, is all calculated, self-calculated. Okay. So there's no need to touch anything here. You just want to keep up with the year that you started, okay, so that you don't go past the 5 years or the 7 years. That's all. But you could take note as you go along. So a little bit of manual work there and effort there. Then same here. This is for interest expense. Year end, you will get the statement. Usually there's your final statement sometime in December or maybe even January. It'll state on there total interest paid for the year. Okay. So for these loans here on the balance sheet, and in particular, this is other loans. This is third-party loans, whether it's a vehicle loan or a loan from the credit union or a loan for furniture and fixtures, whatever the case may be. They all send statements so that you can send that monthly payment towards the loan. Okay. And again, that final year statement will have interest paid. That's what you're entering in here. Okay. All right. So let's do a quick demo. Let's just get into some numbers just to see how it works. Okay. So let's just say we started, after you get this step 1 is initial step only. When you get done with this step, you don't ever record anything here again. You start with step 2 the following year, okay, and so on and so forth. Okay? So again, let's just change some of the numbers, see how it works. Let's just say you were in year 2, and now you're at 6 figures per month. So 125, okay. For January, for February, let's just say 110. All right. And then I'll change a few of the expenses. Advertising. Reason why you're pulling in 6 figures now is because you boosted advertising to, let's say, 25,000 per month. Okay. For January, February, 38,000, and so forth, right? All right. So I'll go out to step 2. Let's say you purchase a vehicle. As you get into 2026, $45,000. Okay, $2,000 paid from your business account, $500 paid from your personal funds, and $42,500 paid from or funded by the dealer, okay, or your credit union. All right. Let's look at the profit and loss, see what happens. All right. So now income is at $817,000. Let's just look at step 3. It's picking it up, $817,000. Okay. Everything's still in balance. Let's check the balance sheet. Everything is still in balance. And we're looking at the end of year amounts, 623. It's all in balance. Okay. Now, I forgot to mention this. When you're starting after the initial year and you're starting the next year going forward, okay, for each of the subsequent years after, right? You want to go ahead and hard code in these ending balance numbers. They will become your beginning balance numbers, okay, for the following year. Okay. So in other words, end of year 2025, logically, if you think about it, that will become beginning of year 2026. All right. So like I said, we get done with 2025. We're moving into 2026. So everything here, before we even get into entering the transactions and playing with the numbers like we just did, the very first thing you want to do is hard coding the end of year numbers from 2025 and into the beginning of year column for 2026. Okay, straightforward and simple. It's very important. Okay, and then you can start filling in what's applicable for that current year and that you're gonna be working in, right? The upcoming year that you're gonna be working in, which is 2026, and in continuing example, like we just went through. All right. So everything still balances. Profit and loss. Net income is 236,459. Ending equity. A statement of changes in owner's equity, 229,826. And it all checks out. You could check it out and see if everything balances here. Okay. You can see if the amounts flow over. And everything should be in balance. And you should be able to prove that everything is connected, ties in, and flows. And as accountants, that's what we can appreciate, right? Is everything is connected, tie in, and flows. All right. And there'll be a lot of the fields are hard protected. The calculated fields will be protected. and that's to maintain the integrity of the financial statements. Okay. Okay, before I conclude, let me go back over the end of year procedures. Okay, so we're assuming that we have come to the end of the fiscal year. The books are closed, and we're starting the books for 2026. Okay, so the very first thing that we need to do is, like I said, before we get started with the new year, is to hard code over the end of year amounts to the beginning of year columns. Okay, end of year 2025 becomes beginning of year 2026. Okay, the end of year columns, those are calculated fields, and they will change as we hard code over to the beginning of year columns. Okay, the beginning of year columns are also calculated fields, but only based on step 1. All right, so they only need to be calculated fields for the very initial setup. All right, I will lock and password protect the end of year columns, and I'll leave the beginning of year columns open for editing. Right. All right, so let me just take note of what these numbers are, because they will change. Okay, as I'm hard coding over the numbers into the beginning of year columns, the end of year numbers will change. So I need to know what those numbers are here, or you could print, so you can have it. All right. If this template is helpful and you need a copy, you can email me my business email me at the office, or you could drop me a comment in the comment section below. Okay. Just request for a copy of the template, and I could get that over to you. I'm still contemplating if I should have the template published, okay, publicly, so available for download for everyone, anyone. Okay, so now we have what the numbers are. Now we could just go ahead and enter the numbers in. 27,973. 2,000 stays the same. 2,000 stays the same. This is a 10,000. Okay, so original number is going to be 2686. 78, 61, 7315, 620. 10,005 is the same. Original number here is 191,924. Original number here is negative 17,133. Okay, so something changed while we're not in balance anymore. Okay, this is actually 10,000. I have 1,000 there. All right, we're all in balance. All right, let's keep rolling. So now we could go ahead and get rid of this column. All right. And I also have to update the template also to handle the credit card repayments. Okay, and that's over here in step 4. So now we have here entering credit card payments. Okay, payments to our credit card balances. All right. So, like we said before, starting up in 2026. So we purchased a new vehicle, 45,000. We went over this part already. Payments from the bank account, payments from the funds, personal funds, and then financing company loan amount. Okay. Step 3, we're now doing 6 figures per month as far as revenues. So we update those numbers. So on and so forth, okay? And that was as a result of increased advertising budget, $25,000 a month and north of that amount. Okay, and so on and so forth, okay? And here, let's see how this works. Well, look at the balance sheet, see what we have. We have high credit card balances. We have high loan due to business owner balances, okay? So let's repay a few of those balances, okay? So loan payment to a business owner. Let's pay those back. So about $20,000 paid in January, $15,000 in February, about $7,500 in March, about $6,100 in April, so on and so forth, okay? And then we come to credit card repayment. Credit card payments, it's about, let's say $10,000 January, another $4,500 in February, and $25,000 in March. April, let's say about $7,500 in April, okay? Let's see what happens now. Expenses, as always, getting heavy on advertising, $15,000 there. And this is from paying from the credit card for advertising, okay? $32,000, $17,000, okay? All right, let's see the changes. Here we are. Everything is still in balance. At the beginning of year columns, of course, it should be in balance. This was hard coded from the end of year numbers. End of year amounts are all still in balance. Let's take a look over at revenues. Income is at $938,895. You look at income, $938,895, so it's flowing. All right. Total expenses, it flows $660,726. Net income is $278,169. Ending equity is $447,327. Let's look and see if everything works the way it's supposed to work with these financial statements. All right. We're checking the accuracy, integrity of the functions, of the functioning of how the financial statements are supposed to tie in and flow. Okay. Ending equity 447. First, let's look at retained earnings in the equity section. Okay, retained earnings is an accumulation of net income. So, beginning of year net income was $191,924, and we're going to add to it the net income of $278,169. Okay, it's accumulated. $278,169. 169 plus 191,924 beginning balance, okay? And the 470,093, so that's correct. That checks out, okay? Did that manually, but it checks out. Calculated field checks out. Okay, let's look at distributions. And let me just say, distributions, the concept of distributions and drawings, they're both about the same. Different terminologies, okay? And I'll update the template to have it as drawings/distributions. They're both disbursements from the business for personal use. You use the term drawings for sole proprietorships and for partnerships, owners, business owners, and then you use the term distributions for S corporation owners aka members, aka shareholders of the S corporation. Okay, a C corporation, you don't have anything as far as personal drawings or distributions from the business for personal use in that same sense and concept. Okay, you have dividends at the C corporation level, and those dividends are taxable. Okay, double taxation when it comes to a C corporation. All right. But anyways, let me not digress into that topic. So let's look at distributions. If you notice distributions also, if you notice it's not an income statement or P&L account. It's not on the P&L, all right? It's not an expense. It's nowhere to be found on the profit and loss statement, okay? It's not written off against income, all right? It's down here. Statement of changes in owner's equity, and it's over on the balance sheet. So distributions, change in owner's equity. So this is a change. So let's look at the balance sheet, okay? Beginning of year's numbers, negative 17,133. And end of year, excuse me, negative 33,266. So what's the change? All right. How do we find a change? We take end of year, negative 33,266, subtract negative 17,133. Negative, subtracting negative, what do we do? Negative 33,266 changes the sign, the operation from subtraction to addition, and then the negative 17,133 becomes a positive. So 33,266. Essentially subtracting 17,133. If we follow that logic, and it's 16,133. Okay, and there it is, negative 16,133. Okay, and the equity is at 447,327. So if we add up the entire equity section, $447,327. So everything checks out, everything ties in. Each one of these financial statements tie in. Okay, so the net income flows over here to the statement of changes in owner's equity. All right, and then it also flows into retained earnings on the balance sheet. Everything is tight and tied. Okay, and that's how we check the integrity and the accuracy of the financial statements, that they are functioning the way they're supposed to function. Okay. Auditing takes it a little bit step further. So auditing will check into the actual representations of the numbers. We'll check into the subsidiary ledger and check and make sure those amounts are what they say they are, and verifying title of ownership for the assets on the balance sheet, so on and so forth. So it's a little bit more involved when you actually get into the auditing of the numbers, but in terms of checking the accuracy and integrity of the flow of the financial statements, everything is checking out, okay? And everything is in balance. It's tight as can be. Tight as getting through a needle eyes, okay? Thanks for watching. If you found this video tutorial helpful, please do like and subscribe for more educational videos. Again, if you do need a copy, you could reach out to me in the comments, or you could email me directly at the office. That information is also below. Until next time, all the best to all of you. forward.